Have you ever looked at a company and just wondered, how are they really doing? Well, in this explainer, we're going to pull back the curtain and decode the 3 key financial statements that tell you everything you need to know about a company's health.
So here's how we're going to tackle this. First, we'll get the big picture on what a financial report even is. Then we'll dive into the 3 big ones: the balance sheet, the income statement, and the cash flow statement. And finally, we'll wrap it all up with the key takeaways you'll actually want to remember. All right, so what are these reports anyway? The best way to think about them is like a health checkup for a business. Seriously, they give you a really clear, detailed look at its overall condition, just like a doctor's report. Now, if you've ever opened one of these reports and felt like you were trying to read a foreign language, you are definitely not alone. It can look like a crazy wall of numbers and jargon. Our whole goal today is to translate it into plain English for you.
And to make this super easy, we're going to use one simple, relatable example for this whole thing: a local coffee shop. Trust me, all these huge corporate ideas become a lot less scary when you can picture them in a small business you actually understand.
Okay, first up is the balance sheet. This is like the foundation. It's where you start to really understand the financial position of our coffee shop, or any business, big or small. I want you to think of the balance sheet as a photograph. It's a single snapshot in time. It captures the coffee shop's financial health on one specific day. It tells you exactly what it owns, what it owes, and what's left over for the owner. Now, the entire balance sheet is built on one simple but really powerful rule that always has to be in balance. On one side, you have everything the company owns. Those are its assets. And on the other side, you have everything it owes, its liabilities, plus whatever the owner has invested, which we call equity. So let's see this in action at our coffee shop. The assets? That's the cool espresso machine, the cash in the register, and the beans. The liability? Well, that's the bank loan used to buy the machine. And the equity, that's what the owner truly owns after you account for that loan. Let's break that down a bit more. Assets are just all the things the business owns that have value. For our little shop, that means the physical cash in the till, all the inventory like coffee beans and milk, and, of course, the big expensive stuff like the espresso machine. That's often called property, plant, and equipment. And what about the other side of that equation? Well, liabilities are just what the shop owes to other people. Think of bank loans or maybe an unpaid bill to the milk supplier. And once you take everything the company owns and subtract everything it owes, what's left over? That's the equity. It's the owner's piece of the pie, their real net worth in the business. Okay, so if the balance sheet was a still photo, our next statement is where the action is. The income statement tells a totally different story. It's all about performance over time. Yep, the income statement is like a movie. Instead of one single moment, it shows you how the coffee shop did over a whole period, maybe a month or even a full year. And it's really trying to answer one question: did we make money or not? And here's how it works. It's pretty simple. You start at the top with revenues. That's all the money coming in from selling coffee. That's why they call it the top line. Then you subtract all the expenses, the cost of the coffee beans, rent, employee salaries, everything. And what you're left with at the very end, that's the net income, the famous bottom line. This brings us to a really, really important idea. And honestly, it's something that trips a lot of people up. And that is the difference between having a profit and having actual cash in your hand. They are not the same thing. This quote just nails it. A company can look profitable on paper, but still go completely bankrupt because it runs out of cash. How? Well, sometimes you record a sale before you've actually gotten the money. And that is exactly why the cash flow statement is so critical. So here's the key takeaway. Profit is kind of like an accounting idea. It's a measure of success. But cash is the real-world fuel a business runs on. It's the actual money you use to pay rent, buy more beans, and pay your employees. If the cash runs out, the business just stops. This statement is basically a detective for your money. It tracks every single dollar that comes in and every dollar that goes out. It answers the most basic questions. Where did our cash come from this month? And where in the world did it all go? So it breaks down all that cash movement into three main buckets. First, you've got cash from operating activities. That's the money from the main business of selling coffee. This is the one you really want to see be positive and strong. Next is cash from investing. That's money spent on big stuff like buying a new oven. And last is cash from financing. This is money from taking out a loan or maybe paying one back. This whole breakdown shows you if the company is making cash from its actual business or if it's just borrowing it.
Okay, let's bring this all home. We've looked at the three core statements. Now we need to see how they all work together to give us the complete picture. And most importantly, what you should take away from all this.
So here it is in a nutshell. The balance sheet is the snapshot of where things stand. The income statement is the video of whether you're winning or losing. And the cash flow statement tracks the company's lifeblood, cash. You have to look at all three together. Looking at just one is like a doctor only checking your temperature and declaring you healthy. You need the full checkup.
So why should you care about any of this? Because these statements help you answer the questions that really matter. Are sales consistent? Is the company actually making cash from what it does? Can it pay its bills next month? Is it drowning in debt? Understanding this stuff is step one to making smarter decisions with your money.
And there you have it. You've got the basic tools now. You can look beyond our little coffee shop and start to analyze the real companies you see every day. So the only question left is, whose financial story are you going to decode first?